Right now, in 2026, businesses and consumers are just fighting tooth and nail for every 0.5% of yield they can get on their cap.
Oh, absolutely. It's brutal out there.
Right. Like, we are living in a rate environment where loyalty is essentially dead. Capital just flows instantly to whoever's paying the highest interest.
Yeah.
So how did a regional bank sitting in the Mid-South just convince commercial businesses to park nearly $2.8 billion in accounts that pay absolutely zero interest?
I mean, it completely defies gravity. While the rest of the banking sector is just scrambling, paying these massive premiums just to retain their existing depositors, this institution is actually driving its overall deposit costs down.
Which is wild.
It is. They've effectively insulated their balance sheet from the interest rate war happening everywhere else.
Well, welcome to today's deep dive. Our mission today is to decode this really fascinating paradox playing out in the financial sector. We are looking at the Q2 2026 earnings from FB Financial Corporation, which is widely known as First Bank.
Right.
We've got their earnings presentation dated July 14, 2026, alongside the accompanying earnings release from July 13. And honestly, whether you are an investor parsing bank stocks, a founder looking at capital availability, or just a student of the markets trying to read the tea leaves of this 2026 economy, you really need to understand the mechanics of what First Bank just pulled off.
Yeah, it's a very telling quarter.
Definitely. We are going to explore how they managed to post a $58.6 million net income and expand their loan book at double-digit speeds, all while, tightening their belt for a potential macroeconomic storm.
And that duality is what makes this quarter a masterclass in balance sheet management. I mean, management is aggressively pressing the accelerator on capital deployment, yet simultaneously hoarding defensive reserves like the bottom is about to fall out of the broader economy.
Okay, let's unpack this looking at the top line. The momentum of that acceleration is just massive. Their adjusted pre-tax, pre-provision net revenue, PPNR, hit $83.6 million.
Yeah, up nearly 7% from Q1.
Right. And for a bank this size, seeing that level of core profitability means the fundamental machinery of their lending operation is operating at a highly, highly efficient clip. And driving that profitability is a staggering 11.6% annualized growth in loans held for investment.
Which brings their total loan book to $12.87 billion.
Exactly.
Moving that much capital into the market in a single quarter requires a very deliberate underwriting strategy. They aren't just relying on one lucky sector or a single massive corporate deal to skew the numbers.
Oh, it's really spread out.
Exactly. They are deploying this capital broadly across their footprint, so they're expanding significantly in commercial real estate that's non-owner occupied, up like $147 million.
Wow.
Yeah, and they're pushing residential real estate up $146 million and steadily growing their commercial and industrial portfolios by another $21 million.
See, my immediate assumption when I see 11.6% annualized loan growth in a highly competitive lending environment is that a bank is simply buying market share.
Right, because that's what usually happens.
Exactly. Usually the easiest way to win that many deals and move that much volume is to slash your rates, lower your lending standards, and just undercut the bank across the street.
Yeah, a race to the bottom.
But looking at their metrics, their total loan yield held completely steady at 6.22%. They didn't drop their prices a single basis point from the prior quarter.
What's fascinating here is CEO Christopher Holmes categorizing this specifically as strong organic growth. Maintaining a 6.22% yield while expanding the portfolio at an 11.6% annualized clip, it proves they aren't engaged in that race to the bottom on pricing.
Right.
They are actively winning quality, high-yield loans without sacrificing their margin to get the deal done.
Which implies their value proposition to a commercial borrower goes far beyond just offering the cheapest money in town.
Absolutely.
If you can hold the line at 6.22%, you are competing on execution speed, deep local market expertise, or, perhaps the flexibility of the loan covenants. You're pricing the specific risk of the borrower accurately because you actually know their business.
Yeah, you're a partner, not just a vendor.
Right. But creating nearly $13 billion in total loans requires an enormous pool of liquidity to fund it. You have to source that cash from somewhere.
And the funding side of the balance sheet is where most regional banks are feeling the most acute pain in 2026. Sourcing deposits to fund loan growth is currently the hardest part of the entire business model.
Here's where it gets really interesting. We established that First Bank grew their total deposits to $14.35 billion, right? An annualized growth rate of 7.7%.
Yep.
But amidst this brutal high-rate environment, the actual cost of those total deposits ticked down to 2.26%. It dropped from 2.27 in Q1.
Okay.
Seeing deposit costs actually drop while the rest of the industry is just bleeding margin to retain cash, it feels like a mathematical error at first glance.
I know, it really does. But it's entirely driven by a highly strategic shift in their deposit mix. Specifically, that non-interest-bearing deposit segment we hinted at earlier.
Right, the zero interest accounts.
Exactly. That specific bucket grew by an impressive 16.7% annualized, reaching $2.78 billion.
I really have to push back on the mechanics of this, though. I understand the baseline math. If you mix more zero-interest money into the pool, it drags down the average cost of the entire pool.
Sure.
But who leaves millions of dollars in an account paying 0% today?
Yeah.
Are these just sleepy retail customers who simply haven't bothered to open a high-yield savings app on their phones?
No, not at all. These are commercial operating accounts. The presentation notes that checking accounts now make up 37% of their total customer segments.
Oh, wow.
Yeah. Think about the daily reality of a mid-sized local manufacturer or a regional logistics company. They have daily cash flows that require immense immediate liquidity.
Right.
They have payroll clearing on Fridays, vendor payments executing daily, inventory purchases requiring instant wire transfers.
Okay, I see what you mean. Because the administrative friction of sweeping every spare dollar into a money market fund every single night, only to pull it back out the next morning to cover accounts payable, that's a massive operational headache for a CFO.
It's a complete nightmare. They are trading yield for a seamless treasury management experience. And acquiring these accounts is the ultimate competitive advantage in regional banking.
It locks them in.
Exactly. Once a business integrates its payroll systems, wires its accounting software into the bank's API, and sets up automated vendor disbursements, the switching costs become enormous.
Yeah, a business isn't going to rip out its entire financial plumbing just because a competitor down the street offers an extra 50 basis points on a sweep account.
The inertia is a feature, not a bug. First Bank has effectively built a moat of zero-cost, incredibly sticky deposits.
So even if they have to pay highly competitive premium rates on their time deposits or CDs to attract the rest of their funding, having a $2.8 billion anchor of zero-cost capital perfectly insulates their overall deposit cost.
Precisely. Which explains why their net interest margin on a tax-equivalent basis actually remained stable and ticked up slightly to 3.95%. They're managing the spread flawlessly.
It's like the purest validation of the relationship banking model. You solve a complex treasury operations problem for a commercial client, you win their zero-cost operating account, and you use those highly stable, cheap funds to originate high-quality local loans at 6.22%.
That's the engine right there.
But let's pivot to the other side of that paradox we set up at the beginning. We have this aggressive growth funded by an incredibly efficient deposit base. Everything looks structurally sound.
It does.
Yet simultaneously, they are aggressively hoarding cash for potential losses. The provision for credit losses jumped significantly, moving from $3 million in Q1 to $10.1 million in Q2.
Yeah, tripling the provision quarter over quarter demands a close look at their internal modeling. Though, to be fair, more than half of that $10.1 million increase is simply the mathematical reality of having a larger loan book.
How so?
Well, when you originate that much new volume-growing loans by 11.6%, regulatory accounting standards require you to immediately recognize and set aside reserves for the expected lifetime losses of those new loans.
Okay. So building these loss reserves while aggressively growing the loan book is like adding a heavy-duty suspension to a commercial truck.
I like that.
Right. It might slow your overall top speed down slightly because it adds weight and requires capital, but you absolutely have to install it if you're planning to carry a much heavier load over unpredictable rough terrain.
That is a highly functional way to visualize the mechanics of bank capital. And that unpredictable terrain is explicitly mapped out in First Bank's macroeconomic models.
What are they seeing?
If we connect this to the bigger picture, the forward-looking models they rely on to dictate their reserving for the second half of 2026 into 2027 are baking in several specific, highly concerning headwinds.
Yeah, I noticed they explicitly modeled for slight inflationary pressures and moderating GDP growth expectations. They are also factoring in the persisting geopolitical uncertainty in the Middle East, along with the delayed benefits of lower oil prices at the end of the quarter. It reads like they are pricing in a localized domestic economic slowdown, running parallel to global friction.
And based on those specific inputs, management proactively pushed their allowance for credit losses coverage ratio up to 1.51% of total loans. They are pre-funding the reserve before the economic weather actually turns.
Right, but reserving for hypothetical future pain is one thing. We have to look at the actual distress in the portfolio right now. Net charge-offs, the money they have actually had to write down as unrecoverable, are almost non-existent at 0.06% annualized.
Basically nothing.
Right, they're effectively losing $0 today. But non-performing assets, or NPAs, did tick up, moving from 0.98% to 1.14% of total assets.
The earnings release provides a highly granular explanation for that specific uptick, though. It wasn't a systemic deterioration across their entire borrower base.
Oh, good.
Yeah, it was driven primarily by the migration of three specific lending relationships. Management noted that two of those relationships are now individually assessed for reserves, and the third is well collateralized and being actively managed.
Being that transparent about three specific relationships suggests they have a highly aggressive internal risk identification system. They are isolating the problematic assets, cording them off, and funding reserves against them long before those loans deteriorate into actual charge-offs.
It is a philosophy of early recognition. I mean, they aren't waiting for a borrower to formally default to start figuring out how much the recovery process is going to cost the balance sheet.
Which makes sense. Speaking of potential defaults, let's talk about the absolute elephant in the room for any regional bank operating in 2026 commercial real estate, and
Right.
specifically the office sector.
Ah, yes.
The office sector. With remote and hybrid work essentially cemented into corporate culture, office valuations have faced severe historic compression. Where does First Bank sit in that specific blast radius?
Honestly, their exposure there is remarkably minimal. Office loans represent only about 4% of their total loans held for investment portfolio.
Only 4%.
Yeah, it is a fraction of their overall risk. Furthermore, 97% of that small office slice is pass-rated and current, meaning the borrowers are performing exactly as agreed.
That's reassuring.
But the most critical detail they highlighted is their structural underwriting standard. These projects generally require 25 to 30% cash equity, with loan-to-value maximums tightly capped at 70 to 75% at origination.
Wow. A 25 to 30% cash equity requirement seems incredibly steep for commercial real estate developers in this capital environment. My guess is First Bank is using that strict equity threshold as a natural filter.
Definitely.
Only the most well-capitalized developers, the ones who truly believe in their project's long-term viability and have the cash to prove it, can even afford to sit at the negotiating table with them.
That natural filter is exactly the point of the policy. That required equity represents the developer's skin in the game, but structurally, it functions as the bank's primary shock absorber.
Right?
If the underlying value of an office building drops by 20% in a severe market correction, the developer's equity is wiped out. But First Bank's principal remains fully covered by the remaining asset value.
Oh, that's smart.
It severely limits their downside exposure to the one asset class the rest of the market is sweating over.
So what does this all mean? Let's look at the comprehensive picture. We have a bank generating massive core earnings, executing disciplined double-digit loan growth, sitting on a fortress of low-cost operating accounts, and proactively reserving against future macro headwinds.
Yep.
When a management team successfully navigates all of those competing pressures, it generates a substantial amount of excess capital.
And the way they chose to deploy that excess capital in Q2 is perhaps the strongest forward-looking signal in the entire earnings package.
Okay, let's hear it.
They executed share repurchases totaling over 1.5 million shares. That equates to roughly 3.01% of all outstanding shares, retired in a single quarter.
Wait, retiring 3% of your outstanding equity in a 3-month window? That's an incredibly aggressive capital allocation maneuver.
It is. It signals absolute conviction from the executive suite regarding their intrinsic value, and they have a fortified balance sheet to support it.
The numbers back it up.
Exactly. Their tangible common equity to tangible assets ratio, which is a very strict measure of hard, tangible capital against total assets, is incredibly strong at 9.49%. Combine that capital density with $1.8 billion in on-balance sheet liquidity, and management possesses profound optionality.
So by aggressively repurchasing shares, instead of, say, chasing an expensive geographic acquisition or pushing a one-time special dividend, management is looking at the broader market, looking at their own internal projections, and deciding the single best, most accretive investment they can make is in their own franchise.
Precisely. They clearly believe the public markets are significantly undervaluing their long-term earning potential.
Makes sense. Though, for a completely balanced view of the quarter, we do have to acknowledge the areas where they experienced friction, right? It wasn't seamless across every single business line.
No, it wasn't. The mortgage banking segment faced genuine, sustained pressure.
Yeah. Revenue in the mortgage segment dropped to $14.9 million,
Yeah.
which honestly isn't entirely surprising given the macroeconomic context we've discussed. We have continued market volatility, bouncing market interest rates, and consequently, lower lock volumes.
It is an incredibly hesitant homebuyer environment right now.
Very true.
Top-line revenue was undoubtedly pressured by those macro realities. But what stands out to any analyst looking at these numbers is how management adjusted the internal dials in response to that external pressure.
What did they do?
Well, while revenue is dropping, they actually managed to improve the mortgage segment's efficiency ratio, bringing it down to 82.9%.
So it is structurally costing them less to generate every dollar of revenue.
Exactly.
They achieve that by directly addressing personnel costs and rapidly right-sizing their expense base to match the current lower volume reality of the 2026 housing market.
That operational agility allowed the segment to still scrape out a $1.6 million pre-tax net contribution despite the severe top-line headwinds.
Wow. So they didn't just accept the loss, they engineered a way to maintain profitability.
Right. It demonstrates a very tight grip on operational levers. When the market gives them volume, they capture the revenue. When the market restricts volume, they immediately cut the fat to protect the bottom line.
Which kind of brings us back to the core thesis of this entire deep dive. First Bank's second quarter is essentially a masterclass in disciplined paradoxical execution.
It really is.
They're driving an aggressive double-digit loan growth engine funded by a remarkably sticky zero-cost deposit base while simultaneously bolting on the heavy financial suspension required to navigate a potentially turbulent macroeconomic environment.
They're successfully playing aggressive offense and cautious defense on the exact same play.
And for you listening, whether you are analyzing Mid-South commercial real estate, running a local business, or evaluating the broader commercial sector's health, this balance sheet is a direct reflection of the local economy's vital signs.
Yep.
The local gears are clearly turning, businesses are borrowing and operating, but the operators managing the capital are keenly aware of the clouds forming on the horizon.
This raises an important question, though, if we look even further past that horizon.
Oh.
Yeah. Deep in the fine print of the forward-looking statements in this release, there is a standard but vital risk factor regarding the adoption of artificial intelligence and emerging technologies.
Right.
Think about everything First Bank achieved this quarter, acquiring those sticky operating accounts by solving complex treasury needs for local founders, and rigorously vetting real estate developers to enforce a strict 30% cash equity standard.
It's all highly manual, relationship-driven work.
Exactly. All of that success relies heavily on localized human relationships and granular market knowledge.
It is the quintessential traditional relationship banking model working exactly as intended.
But in a future where advanced AI and algorithmic models can instantly underwrite a commercial loan or optimize a treasury system using billions of nationwide data points, we have to ask a structural question.
Which is?
Will this relationship-heavy model of regional banking sustain its competitive edge? Or will that granular, local knowledge eventually be outsourced entirely to the machine, making capital purely a commodity?
Wow. That is a fascinating tension to leave on. Can the local handshake, the customized treasury solution, and the deep human market knowledge hold the line against a purely algorithmic approach to capital allocation?
It's going to be interesting to watch.
It really is. That is absolutely something to ponder
Yeah.
as you look at your own industry's exposure to technological shifts. Well, thanks for joining us for this deep dive into First Bank's Q2 earnings. Keep asking the hard questions, keep interrogating the data, and we will catch you on the next one.